What is tortoise head?
It's
Portishead. You gotta.
Portishead.
It's love
is
making
that?
music, man. It's the best.
Oh, dude, I need to get some of that.
it's trip hop.
Portis.
Is that what it's called? Trip hop?
I learn something new every time we do this show. This is great.
These are the best parts of our show right here is this stuff.
Yeah.
We should just say, all right, thanks for calling Financial Detox. Hello, it's Financial Detox. I'm Jason Labrum in studio with my man.
Alex Klingensmith.
Are we done? Cut the show because we already did it on the pre-show show.
No, I was just learning more about music from you guys.
Right. Because Shane is a music expert. She has passed all tests that we've thrown at her. Remember what was that last one we did, Shane, when we talked about, or were we just playing good music? What was going on there?
You were trying to stump us, Jason.
Oh, yes. We were singing
I think it was Rob Bass.
Yes. Was it Rump Shaker?
Yeah, that was it.
We should have a show where we just start playing the songs and Shannon just has to name the name as soon as she can remember, figure out what song it is.
Oh,
I could totally do that.
yeah.
She would crush
100%.
it. Should we do one? Let's do a test. All right,
Portis head. Let's do
All right.
Portis.
No, she knows that one. All right. This will be a good one. See if you know this one.
Like no effects or something?
Oh, face to face.
Oh.
Face to face.
Stumped us all.
See, I don't know them.
Wow. All right. So we're out of the punk. So we got her. We got her on punk and country.
Got her.
Got her on punk and country. That's good. All right, we'll do one of those each show for a while. Just see if can Shana guess this artist.
There you go.
Well, welcome to Financial Detox. We are going to talk about something money related today. Now that we've gotten through our music trivia, but lots going on in the markets, of course, as always, lots to talk about. And Alex, thanks for coming up with a good topic today, because this has been something I'm seeing almost every single day with clients or prospective clients that have a lot of cash on the sidelines. I think you even titled our show today. What did you title it?
I think it's like dry powder, how to invest in 2025.
Yeah, or cash is not king. Didn't you say that?
That's right. Cash is not king.
Cash is not king. Why is cash not king? I mean, there are times when cash is king. I don't know when those are specifically, because historically, if we look at investing, you have a 74-ish% chance of making money in the stock market, diversified portfolio of stocks, on a 1-year time frame. So if you go 3 years, that percentage goes up, 5 years goes up dramatically. And if you're diversified into other things besides just stocks, even some bonds and alternatives and different things, then those percentages go up even higher and faster.
Cash would be king if you're trying to maybe deploy into something that's on sale, right? You're buying something that's a value, like a Warren Buffett type, like I need cash to buy something that's a value opportunity.
Sure. There's a lot of people get caught in value traps too, trying to catch that falling knife, so to speak. But how about having cash available is always good if the market's down, like significantly down. When would you create that cash? I suppose would be when the market's up, right? You would trim profits, hold cash, wait for it to go down. The problem with that historically is it's a form of timing the market, and it doesn't really work out well. You're better to just be invested. It's not. Yeah, the old saying, which I think actually Warren Buffett was one of the guys who said this, is it's not timing the market, it's time in the market. Yeah. Because eventually, by being in over longer periods of time, you extract those returns out of the markets and good things happen. But I think there was a time where cash, especially when interest rates first went up and the markets were really quite volatile, adjusting to higher interest rate environment, and you were picking up like a 5.5 yield on good money markets, that was a pretty attractive place to be, especially after coming off of 25 years or 20 years, 18 years, whatever it was, a long time frame of really low interest rates, right? Where your money markets were paying zero, and it was really hard to go get any return in a cash alternative or a cash type investment. So it was so attractive. And I think we were even attracted to it, right? You're like, oh my gosh, all of a sudden cash is an asset class again.
22, beginning of 2022. I mean, everybody who like timed that right looks like a genius, but I mean, how would you have predicted the next 2 years after that if you were still in that money market? And then 2023 and 2024 market-like returns that were 4 or 5 times more than those money markets.
Yeah.
Not so smart then, right?
Yeah. And you know, time though, that cash is great. When is cash great? When you have the need for some of your portfolio or some money over the next 3 months, 6 months, even 12 months, cash is brilliant. And now if you properly manage that cash, you can actually get a great yield. And the reason why I say over the next 3, 6, 12 months, maybe even 15, is because you don't want to have that money invested in something when you know you're going to use it that could potentially be down. And what if it's down 15 or 20% right when you actually need it? You would have been better to just take the 4 or 5% yield in cash. So I think that's the big point. But what we wanted to do today is something just a little bit different. We've gone to our financial planning tools, which we do tons of financial planning. And really, I think life begins at a good financial plan. And what I mean by that is that's when you can set yourself free. It's when we set our clients free so that they know how much money they can live on. And oftentimes it's not only they have plenty of money to live on, but it's how do I maximize my life? What if I really want that vacation house in the wherever or at whatever location, fill in the blank for what's right for you. We can show people unequivocally whether or not that's achievable. And that's awesome. What an experience to know, to set your mind free, to know, hey, I have plenty of money to live, great. But now I want to maximize my life. I want to fly first class. I want to have this home in the mountains. I want to, invest in my kids and help them get their business started or buy their first homes. All those things you can know definitively. And when you have a plan that incorporates all the cash flow and all of the analysis involved in looking at those numbers, you can make the decision with a lot of ease. It becomes really fun to make the decision as opposed to kind of stressful.
That's right. It can even bring out, I think, the fun within a relationship. If let's say you're married and you have a spouse who maybe is the money person and you're not. You don't really check the bank accounts, the investments. It's not really very exciting to you, but you do very much care about, your financial health and the health of your family and your ability to make good decisions with money. So if you're able to have a kind of a, if you will, a financial therapist in your life, like one of us, an advisor who uses a tool like this to be able to kind of communicate visually with data, but in a way that's more, here we go. It's perfect segue, right? Yep. If you're able to see something like this and see your life on a screen and be able to ask questions that maybe, you wouldn't normally ask because the jargon of our industry can be very daunting, right? That's a really fun experience for people to be like, oh my gosh, I actually finally get it. I see what we're doing here. I can make the decision to change jobs and move across the country or whatever, right?
Perfect. I mean, this is an example we ran on somebody who has cash, where cash is not king. You've got all this dry powder and they're like, what should I be doing with it? I'm earning 4%. If you look at inflation, maybe it's a break even, right? After taxes, you're probably actually losing money in cash. So you got to go be more intentional about that money. And this is a sample of our plan. This is a test client here. So no actual clients, and everything we're talking about is hypothetical in nature, of course. Past performance doesn't guarantee future results, all that typical disclaimer stuff with no intentions of being misleading. But what's really cool here is we're looking at a client's financial plan and we're able to, I can even make this a little bigger. I think that helps maybe, but we're able to say, okay, Mr. and Mrs. Client, these are your portfolio assets over your life. And pretty cool. All right. Your plan looks good. You have money. You have plenty of money. But maybe this client says something like, and I'm going off script here, standard, right, Alex?
What are you going to do?
I'm going off script. But this client, this is pretty standard protocol, I guess, right? But let's say this client adds another expense to their plan. And this expense is going to be, I'm giving $100,000 a year to my sister because she can't figure herself out. And so we can, on the fly, run that number and look at how, they were right on the edge there. The impact of giving away $100,000 a year for several years really hurt, right? So
they ran out of money.
Ran out of money. And we always like to say, well, what happens if we're stress testing this and we are, saying, well, let's look at good markets. Let's look at some bad markets. Let's look at randomly calculated returns based upon historic market volatility. And with this other expense, wow, they only have a 54% chance of not running out of money. So this is not good. So the client says, well, my sister's going to have to try and live on 50,000. So
for 9 years, 9 years, you're helping her out.
Yeah, I threw in 9 years there.
Okay.
And well, boom, we got the success ratio up to 77%.
Still not great.
It's not great. It's a go zone though. I'd feel comfortable telling this client, look, you can do this. We'll monitor it obviously every quarter, semi-annually or half.
What was it before that helping of the sister situation?
Well, and that's pretty cool. I forget your sister. You're not giving money. Look at your 85. Success ratios.
I mean, that's my comfort zone. I'm a B student right here, right?
Man.
I don't know about anything below B.
Yeah. So look, 85 solid, right? 85% success ratio. And that doesn't mean that there's a 15% chance this client's going to fail. This simply means that there's a 15% chance you may need to make some adjustment at some point in your future, Mr. and Mrs. Client, right? You may need to spend a little less. You may need to invest a little more aggressively to get a higher rate of return.
And they have 40, this is like a 45-year time horizon on this plan. It's like 2025 going on to 2070 or something,
younger middle-age-ish clients. So so what we did was we threw this simulation with your help, Alex. Thanks, man. We put together a simulation of let's take the money they have. In this case, it was just 600,000 sitting in cash, AKA money market. And we said, well, let's get that invested and let's actually invest it in alternative investments, private investments, an asset class they didn't typically have exposure to. And you see the probability jump from 85 to 94.
A student.
Now
much better.
I like that.
Yeah, A students crushing it. And we go back to the linear and we say, okay, this is now looking good. Well, let's go back then and just give some money to our sister again.
Oh yeah. How much are we giving her in that one? 50,000
50.
again?
Yeah, we're back to the 50.
I'll take some money for giving it out.
Yeah, and Brian's going to get, let's put a Brian fund in here. Shayna, if she wins music trivia, she gets money. If not, she doesn't.
Yeah.
Oh man, there's a lot of pressure. What does Brian have to do though?
Not make the show crash.
Yeah, there you go. The show doesn't crash.
80%.
Yeah. So we're at 80%. If you turn off the cash replacement and you say, all right, no, we're keeping it in cash. Yeah, you're back down to 77, not terrible, livable, but we can certainly improve the outcomes with the goal of being, let's get the highest probability of success and let's improve our outcomes if we can.
Yeah. I like it. And I think it's also probably good to share the reason we've been talking about private alternatives a lot these past few years on this show and with clients and just everywhere we are, right? All places where we live. And now it's interesting, Jason, this year it is another kind of title for the show, Private Markets Gold Rush, right? What is happening in private markets and why is it happening? I think is worth mentioning.
Yeah. Well, and here's just one screen on one segment of private markets. So just so our listeners know, and so they get educated up on this. If somebody says private markets, they also mean alternatives. If they say alternatives, they mean private markets. Generally speaking, those are big buckets. It would be like saying publicly traded stocks. And in stocks, right, there's tech stocks, there's value stocks, there's consumer staples, there's cyclicals, there's utilities, there's all kinds of stocks. Same thing when you talk about alternatives / private markets. There's lots of different asset classes within that. The scenario we ran was a private equity that you just saw. This is just a little excerpt on what's happening in private credit. And what is really interesting is you look at the annualized returns for a pretty good time frame here, 9 years of bank loans, high yield bonds versus private credit. And you can see that private credit has substantially better returns. And when you go look at historical default rates, direct lending, AKA private credit, is really low with very high recovery rates, whereas defaults in high yield bonds or bank loans is higher with much lower recovery rates. So you have, for all intents and purposes, historically speaking, and past performance is not guaranteed, future results and all that, but you have an asset class that gives you a higher rate of return with technically less risk or less volatility. That's a pretty powerful story when you start adding that into your portfolio.
I think it makes sense too for that. If you go back to the client that we were talking about and maybe go to the overview tab where you can kind of see the overview of the entire, that sample client's entire net worth and their investable assets. When you start to think about this, try to find yourself in this story, right? Whoever's listening, we put together this financial plan. We go through all of the client's assets, all the liabilities, all their income, all their expenses, and we project forward. If we're looking at recommendations on how to take that green box and really manage it really well and diversify it and create less volatility with higher expected returns, making the blue box also go up, that's your financial freedom. That blue box is really what you should focus on. That requires a lot of comprehensive financial planning, not just in investments, but in insurance and taxes and retirement and all these other buckets. If you scroll down just a little bit, so our firm, hypothetically in this one, we'd be managing the assets under management, about almost $2 million in those accounts. And then down below, there's that dry powder at the very bottom, 600,000. The client's coming to us and saying, what do I do with that 600,000? I've been scared to invest. Yeah. Tariffs freaked me out. I don't know how long it's been at 600,000. Let's say it's been there for a couple of years. What do I do? That's where the private alternatives it's 4 new asset classes they don't already have, right, Jason?
Yeah, exactly. When you look at it historically, the percentage of allocation retail normal investors, mass affluent, high net worth have in alternative or private assets, it's really small. But when you look at institutions or endowments, technically more sophisticated investors with investment committees and investment policy statements, those percentages are sometimes now pushing 50 and 60% of their total allocation is towards this asset class that is just different. It's private investments. And only historically speaking, no guaranteed for future results, theme of the day. But when you look at private equity versus public equity, so private stocks versus public stocks, you have a higher expected return with lower historic volatility. In private bonds and private debt versus public debt, you have a higher expected return with lower expected or historic volatility. And then you add in things like real estate or infrastructure, and you get other really great asset classes that are not correlated. They don't act like stocks and bonds. So when you get assets that have a high expected return or a good expected return, and they don't act like stocks or bonds, traditionally speaking, then you create a less volatile portfolio and a higher return over time. So it's a great thing to be doing in your portfolio, we believe. And technology and just growth of our industry has created new types of fund structures and investments that allow investing in these, what used to be really hard to get assets. That's why only huge money endowments and institutions invested in them. And now you can invest in these with as little as sometimes $1,000 or $25,000. So it's really cool. You bring up advancements for
You bring up a good point. I think if I'm listening to this show and let's say I'm this person that's the sample client that we put on there. I got, $3 million investable assets. I've been investing my whole life since I started working for 20, 30 years now, 40 years. What are you talking about? Like, I have a hard enough time picking like the ETFs or mutual funds or stocks in my 401k. And like, I trust you guys to manage that. Now, how do we help people understand where to even start this process of looking in the world of private alternatives? Or should they only ever trust professionals like us?
It really depends on the person's individual sophistication and level of understanding. It is complex. Alex, I've done this for 27 years. I think I've been saying that for a lot of years. So I was either ahead on the years or now I'm behind. I don't know which one.
I think I'm going to say 26, knowing that you started in 99, right? I've heard that story a few times now.
98.
98. All right, then 27, then you got it. 27.
Okay, we'll go there.
Yeah, there you go.
I think I've been saying that for a couple of years, so I must have been off before. But
sometimes you round. Sometimes you round.
We're catching up. The more I do what we do at IDA and Financial Detox, the more I realize how this is really complex. Like, I kind of took it for granted because I grew up in this business, right? I had a father who was a financial advisor and grew up in this my whole young life, adult life, learning it, study, and really was a student of it. Like, I love this. I love what we do. I love investing and maximizing opportunities.
You wrote a book about it even.
Wrote a book, Financial Detox. But
bestseller.
It's very, I think we were a bestseller for like 1 hour when I went and bought a whole bunch of copies to give out.
1 hour.
We still have extras if anybody wants a
Yeah,
copy.
we're
We've
a
got-
New York Times bestseller for 1 minute and 30 seconds. The could have taken that a lot of directions. It wouldn't have been good, but I got Brian on it. It's complex, right? I mean, when you talk about stocks and you talk about ETFs and you talk about mutual funds and internal expenses and share classes, and then add in cash flow and cash flow analysis and Monte Carlo and probability analysis and spending and taxes and tax efficiency and rebalancing. And I mean, holy cow, it really is complex. I'll tell you a story. I was talking to a friend the other day. He's a very smart friend, younger than I am, 12 or so million dollars investable assets. Family has maybe 100 million investable assets. This is a smart dude, right? He's been around business his whole life, been around wealthy individuals. And I was talking to him as if he should know exactly what I'm saying. And there were 3, 4, maybe 5 times in the conversation, because we're really good friends. So he's very blunt and honest. He's like, I have no idea what you're saying, Labrum. I have no idea what you're saying, Labrum. He just kept saying that. I have no idea what you're saying. And I'm like, what do you mean you don't know what I'm talking about? And one of the things I was talking about was like custom indexes and building your own index of stocks so that you can tax loss harvest. And he's like, I don't know what you mean. What do you mean tax loss harvest? I don't know what you mean custom index. Individual stock positions. I'm not sure what you're saying. And I was like, holy cow. More and more you realize that it's complex. And so to answer your question, Alex, when you talk about alternative investments, there is a whole nother layer of complexity and just understanding. I mean, investing in, there's roughly 4,500 publicly traded stocks that have 100 million or more of revenue. Don't quote me on the exact number, that's rough. But there's 45,000 or so, rough numbers, of private companies that have over 100 million of revenue. I mean, so people are like, well, what's a private company? What's a public company? It's complex. I think people are best served, and this sounds self-serving, but it's not. I think people are best served, unless they have a complete mastery of all these things we talk about, to have help, but have the right kind of help, because not all advice is created equal.
Well, that's okay. And that's why we oftentimes use the metaphor of like doctors, not that we're saving people's actual lives, but we are saving their financial lives. So if it's that serious to you that you really want to make sure that you have financial freedom and peace of mind in your financial world, why wouldn't you trust an expert? Why wouldn't you go and interview a few of them and ask all these questions and find out who you have the best potential relationship opportunities with for trust and confidence in what they do, and that they care about you and your family and your goals?
And they work from a structure that's a good structure from which to serve you.
Yes.
And that's where I lean towards best interest contract versus a true fiduciary that's legally bound to act in your best interest while disclosing all conflicts of interest under the duty of loyalty and care, blah, blah, blah.
So basically know how they get paid and know what their agenda is. That's what you mean, right?
Pretty much. Yeah, in English.
I think we should offer listeners something. This is one of those call to action moments where
do it.
If you've never invested in private alternatives, or if you've invested in private alternatives and you want to learn how we do it, which is, by the way, it's all opinion based. There's no black or white, true or false in this particular equation. You don't know until later, and you look back and say, that was a good idea. That was a good decision, right? We would love to walk you through our private alternatives assessment, we'll call it. Like, how do we make decisions on which asset classes within private alternatives to pick? Which managers do we like and why? Manager selection is really important. What kind of fee is an appropriate fee in our opinion versus what's not appropriate? Those kinds of questions, we would welcome and invite you into that conversation.
Yeah, I think it's really good. So you can always check us out at financialdetox.com. And that's probably the first and easiest place to get a hold of us. You can send an email straight to my inbox, jason@financialdetox.com, and you will get a reply very quickly. But it's a big topic. It's alternatives. Today was really hitting on just cash and how it matters. What you do with your cash can make a difference. So if you're sitting on $250,000, $500,000, a million, whatever the number is, even $100,000, and it's in cash not working for you, and you don't need that money in the next 12 to 24 months, then you probably want to deploy it. And maybe equities aren't the best place to deploy it, public stocks right now, because they are pretty expensive. They've been on a really great run. In fact, private equities have underperformed public stocks and public equities more in the last decade than they have in a long time because public stocks have done so well, led by the Magnificent Seven, the big tech stocks. So it is a really interesting time to start to understand and learn what are these private investments, what are alternatives, how can I get access to them, and how can I have it make an impact. And Alex, I was thinking about something else and we'll close on this. Like, we have a lot of fun. We have really great human beings that work here, and we're a fun group of people. I mean, we have surfers, heli skiers, snow skiers, boaters, hunters, fish. I mean, we're fun. And
music aficionados.
We have music aficionados. You know, there's really good stuff going on. But I think what it lends to is that when we are looking for clients that we want to work with, they're people who share an enthusiasm for life. Because part of managing money, maybe the biggest part of managing money is maximizing your life. Money is certainly not the most important thing, but it does give you the ability to enjoy what often is the most important thing. Family, friends, leisure, sports, hobbies, vacations, whatever it is that you love to do, philanthropy and giving to other people and helping other people. So by optimizing your financial plan and creating the best scenario for yourself, it's not about, do I have enough money? Oftentimes for our clients, it's not about, do I have enough money to live? It's about, how can I just make my life radically awesome? How can I do cool things and live out loud and live a life of abundance? And that is maybe sharing, maybe it's travel, maybe it's sports, hobbies, vacations. For me, it's activities. I love to fly planes and play golf and ski and surf and do all those kind of things. And I think that's what we do, right? We help people have better lives, and money is just a medium to accelerate that. It's an accelerant to create a great life where you can give to others and really enjoy the things that are most important. So financial detox is about that. When your health is detoxed, you live a better life, you feel better, you have more energy, you're happier, you're able to treat those around you better. And when you're financially detoxified, you know what you can do, you know what your potential is, your outcomes are, and you get to live with that financial peace of mind. And that's a beautiful thing. So we invite you to check it out. It's Financial Detox. That's what we do here at IDA Wealth and the Financial Detox team. As always, I'm Jason Labrum with Alex Klingensmith. I said it for you that time instead of let you say it.
Thank you.
Thanks for tuning in. We love doing this show. We hope you enjoy it. We'd love your comments, subscribe, likes, all that fancy stuff. We'll check you on the next show.